Welcome to TheoTrade. This is Don Kaufman. It's August 27th, 2018. You are watching the Theo Night video. Let's get started as we have but about 2 minutes left in our trading session. The S&Ps are up a staggering 19 handles. The Russell is left behind. But people, what stands out to me in a trading session like this, I cruise over to the trade tab and I look and say, hey, where's all the volume? 800,000 contracts effectively trading in today's markets. It's absolutely anemic out there. In fact, hedging and hedging activity alone can explain most of the upside kind of momentum that we're seeing in markets. Now, granted, I know that people constantly come in here and they're like, it's fundamentals, it's this, it's interest rates, and they give all the different ideas. How about this is hedging activity? Allow me to show you for just a moment what I mean by effectively hedging activity. So week in and week out, I come on to the TheoTrade and do some nightly updates, or I come on into the chat room and I discuss a little bit about what we term expected move. An expected move happens to be these kind of three lines drawn on the screen. All those it's kind of a range as where we're expected to go based on option pricing throughout the course of the week. This week, it was like plus $31 or minus $31. Now, there isn't any directional bias to this. Like, let's be clear. Expected move, it is a non-directional. All expected move is really doing, and this is a great way to kind of delineate this. The expected move itself, it's kind of just like adding up the at-the-money calls to the at-the-money puts. Now, granted, we're just off this 2,900 number. And if you take a look at the at-the-money calls, the at-the-money puts, in this case, right, there's not a week left anymore, but in this case, they're going to equal about $20. Okay. So let's say that you're a major trading firm and you went out and you sold the straddle. Now, tons of trading firms will blindly sell straddles or blindly sell premium on a week-to-week basis. Why do they do it? Well, they want to collect the $20. But then, those trading firms will, what we term, dynamically hedge this off. Now, this is where the explanation gets kind of interesting. And the reason that I'm explaining this is because, part and parcel, this is why the markets are kind of exploding to the upside right now. So what a trading firm has done is they've gone out, and again, they've just sold the, calls and puts, and assume that they sold them naked, okay? There's the closing bell. So as the market starts to rally up, now there could be a number of reasons that the market starts to rally up. Could be as easy as stock buybacks. If somebody starts going out and they buy Apple, they buy Google, you know what that does? It starts to move the S&P up. Why does it move the S&P up? Because Apple and Google, Amazon happen to be major components of the S&P. So as we go up, what happens to the calls that they sold? Okay, so they sell, for instance, these 2895 calls, and they sell them naked. When you sell something and sell it naked, it produces, if you just sold the calls, it would produce what we term negative delta. Okay, it would produce what we term negative delta. What is negative delta? It basically means you've got a little bit of a bearish position on. And the further we go up, the more negative your delta happens to get. So what does the trading firm go out and do? Well, there is no underlying in the SPX. So what the trading firm goes out and does is they buy the ES, futures. They buy the futures. Why do they buy the futures? Because the futures will provide them positive delta. So what they're effectively doing is, as we go up, they're buying S&P futures, and the further we go up, the more futures they have to buy. Then there's another trading firm that's short the exact same straddle. They have to turn around and buy them. Okay, but then what will effectively happen, and this will happen, the calls that you sold will go so deep in the money that their delta doesn't change anymore. Okay, effectively their delta becomes negative, 1. So if you have a negative 1 delta to a call, and then you have a couple of futures to hedge it off, your positive 1 delta, you're effectively net, it's a wash. You're both long and short. And as we start to rally up, you'll hit these like inflection points. We'll rally up and we'll just kind of flatline. You know why we'll flatline from time to time? Because nobody has to do anything to hedge, because they've all gone out and sold the same calls. Now, let me actually explain this kind of logic in the context of today's marketplace. So the S&Ps are up 22. Well, you know what? Lots of trading firms don't necessarily just sell like Friday options. They might be selling, for example, the what? The Monday options. Okay, you can go out there, you can sell a Monday option. Now, this stuff that I'm going through, okay, on tonight's video, this gets a little bit deep. If you're not like a little bit option centric, you're going to be like, this is getting over my head. But this is what's really driving the market. This is what matters. Okay, not some MACD, some Fibonacci, like, oh, my Bollinger Band hurts. You know, like, I get it. But here, look, this was this weekend, okay, meaning that this was an option, okay. This is an option that effectively expired when? Today. This option expired today. This is the Monday option. Look, as of Friday, there were almost 5,000 contracts of this call open. Okay? So someone somewhere did go out, all right, and they effectively sell this call. So they've sold this call. And that is what? The 287, what? The 28.75s. I apologize. We're rallying so fast. I can't even keep up. It's the 28.75 calls. Okay. So if they sold the 28.75 calls, look where the market happens to be right now. The market right now is just shy. It rallied just shy, okay, of 2,900. So this option has gone massively deep in the money. It explains, okay, the trade that you see going on today. Now, let's look again. Here is right here, and we're actually going to switch this over to Delta. There's your 28.75 call that we were looking at just a minute ago, right? This is kind of the before and after picture. 28.75 calls, trading for about $6, 5,000 contracts open. Well, here it is with a 1 Delta, okay? The interesting part of this, though, it explains in today's trading session, we rally, then we completely flatline. You want to know why we flatlined? Because the options that people sold effectively go in the money deep enough that they become a full -1 Delta. Then the hedging just doesn't have to go on anymore. Okay? There's no need to hedge after we actually rally back up. And you can probably see this maybe delineated a little bit better inside of the S&P futures. We hedge, we hedge, we hedge, we hedge. When the option actually hits, okay, deep in the money, we just flatten out, kind of mellow out from there. It's a big portion, though, of what's going on in markets. And it's one of the reasons that understanding these expected moves is so incredibly important. It's imperative because it's order flow that's effectively driving the markets in today's trading. So to see the S&Ps up some 20, listen, I happen to have a number of bearish positions on. And in fact, even in the weekend video, I talked about, I'm just a bear living in a bullish world. Yeah, undoubtedly. But some of those bearish positions, for those of you that have been watching this, one of them happens to be inside of the XRT. If there was a sector that was down today, yeah, well, we found it. It's down, what? Almost 0.7% in a marketplace that was taking off to the upside. Speaking of which, if you're not currently in this position, it's a position that you might want to consider. I am using a long duration, okay, put in here. That is, I've gone out and I am buying deep in the money puts as a synthetic short stock replacement, and I intend to hold these and roll them, okay, for a fairly vast period of time. With that, once again, Tesla survives yet another round of turmoil. Not much on that front. But one aspect that's worth noting inside of Tesla, the volatility, has now effectively been crushed back from the 100th percentile to the 60th percentile. So what that effectively means, premium sellers, stop your engines. The premium has been sucked out of Tesla today. With that, I want to thank everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.